When you look at the real estate market, it has gotten really tough out there. We have seen mortgage applications near relative lows, home sales have plummeted, and it begs the question, how badly is Opendoor going to do in this upcoming earnings report and conference call? I've talked about this company a few times on this channel, and with earnings right around the corner, I think this is a good time to share what I'm going to be looking for, both the caution flags and the improvements that I want to see from this company. But I don't want to waste your time, so let's go ahead and dive right in. Opendoor is a digital platform for residential real estate. So they're basically the middleman when it comes to buying and selling real estate. The company allows you to find a home, sell your current home, and make it all happen at the same time through one platform. You can schedule a tour at your own time and be able to move on your own terms. Now, it is important to note that Opendoor does not flip homes. The service Opendoor provides is the certainty of an all-cash offer on the home and being able to move on the customer's timeline. So how do they make money if they're not actually flipping? They are involved in selling and buying, which means Opendoor will get many of the extra costs that come from buying a home. One of the main ones is the title and escrow. Having been in real estate for a few years now, the title business is easily one of the most profitable parts of Opendoor. Plus, there's little effort involved. They make a service fee from each transaction when people sell to Opendoor because of how quick and easy it is to sell homes through the company. This service fee is at 5% of the total value of the home. The current economy has made it more difficult to buy housing because of increased interest rates, which lead to lower affordability. So these earnings for the second half of the year are going to be extremely important, not only to help investors understand the housing market from a transactional perspective, but also see how Opendoor performs given this quick change in the market. So here are going to be some things that I will be paying close attention to for this upcoming earnings report. The first thing that I think is important to note is the amount of homes sold has fallen. So we can assume that the transactions will be lower than last year for Opendoor as well. And when it comes to revenue, Q3 and Q4 are probably going to be the worst quarters for the entire year, given the high interest rates and low demand. However, for me, I can't let these quarters dictate the quality of the company's business model. What we are experiencing in the housing market is extreme changes that we haven't seen in many years. We have seen plenty of companies slash their guidance and produce growth rates much lower than before. Opendoor had a lot of home demand pushed up because of the low interest rates. And once we get back to a more normal market where demand is standard, then that is where these revenues are going to be extremely important in my opinion. However, right now, I think a more proper metric to look at is the real seller conversion. In Q1, they reported a 35% conversion rate, and I would like to see close to the same percentage. Now, we probably won't see this metric reappear until the end of the year report. However, last quarter, they did mention that their conversion was higher than expected. The question is going to come down to how many of their current homes will they be able to sell. Bloomberg shared a report from Yipit Data that showed Opendoor's transactional performance in August was not pretty. It was reported that they lost money on 42% of their transactions that month, but some would say that this wasn't even the worst part. In Los Angeles, they lost money on 55% of their sales, and in Phoenix, they lost 76%. And this makes many people ask the question of whether or not this is going to be another Zillow situation. Zillow lost millions of dollars on this business about a year ago. And so the question is, if Zillow did so poorly, what makes Opendoor any different? And how would they be able to do well when prices of real estate fall like right now? First, Opendoor does have more experience in the sector than Zillow. And one significant problem for Zillow is that they just bought every home anywhere in the US. Think about it this way. Zillow exited this business because they were losing money in one of the most largest appreciating markets ever. This market that we are currently in is way different, and that is something that needs to be considered. So we cannot assume that this is going to be another Zillow situation. Plus, it was reported that the chief capital officer, Dodd Frazier, said that the company is losing money but disputes the numbers reported by Yipit Data. He says Opendoor actually made a loss on just 20% of sales in August. Now, the spokesperson at Yipit Data responded that he stood by the 42%, but then went on to mention that it doesn't include Opendoor service fees because they have been offset by the resale costs that Opendoor faces. The reality is that we won't know the actual reports until their earnings come out. But here's how I'm thinking about this. If you are one of the top executives for Opendoor, you wouldn't want to lie about the numbers going into an earnings report. And so we need to take what both of these people say with a grain of salt. Now, September in terms of home prices was not good, as the National Association of Realtors reported higher price drops in comparison to August. I think it is fair to say that this will be a rough earnings report when it comes to the losses that they will take, but I don't think it will be as bad as what many people are thinking. Another thing that I will pay close attention to is the rate of sell-through along along with the number of days that a listing is on the market. These two are extremely important not only to understand the market as a whole, but how Opendoor is doing compared to the overall market. So when we look at their sell-through, the company has continued to outperform the amount of houses that have stayed on the market for a while. Now, we will see how this changes in a much slower market, but I really want to see a good amount of sell-through compared to the rest of the MLS. And this all leads to the number of days that a listing is on the market. And that is one of the most important metrics in real estate. Given the current economy, we will probably see more houses on the market for 120 days or more. In the previous quarter, they reported 5% of their homes were on the market for 120 days. I'm predicting that this percentage will be higher, but we will see how much higher in this upcoming earnings report. And this leads to their revenue projections. The company expects to have their revenues cut almost in half from the previous quarter to between $2.2 and $2.6 billion. Here's the thing though. Even though this is a significant reduction in revenues from the past quarter, there is still growth year over year when you compare it to the midpoint. Now, I personally believe that they will underperform their estimates given the drastic reduction in home sales. I'm expecting around $2.1 billion, but I'm honestly not looking into revenues as much because they are still a growth company if they're in a normal market. The metric I believe is more important given this current economic times is adjusted EBITDA. They're expecting to have adjusted EBITDA in the range of negative $125 million and negative $175 million. Honestly, I'm expecting a greater loss closer to negative $200 million, so I will be pleasantly surprised if they stay within their guidance. Now, the question becomes, what is the company going to generate over the following quarters? And this all goes back to the condition of the housing market. I personally cannot see housing prices crash, which is 20% or more. When we think about a housing crash, foreclosures is a major factor. However, Adam Data Solutions looked at the foreclosure data and here's what they got. August foreclosure starts were at 86% of the number of foreclosure starts in August of 2019. But it's important to remember that even then, foreclosure activity was relatively low compared to historical averages. Now, think about it. In 2019, home prices were much lower than where they are right now, and a ton of people were buying homes at these high prices in 2020 and 2021. So even with these increased prices, the foreclosures are still lower than 2019 levels. Now, for transparency, I do see these numbers continuing to rise even higher than 2019 levels, especially as unemployment rises. But we cannot assume that foreclosures will be as high as before because of the kinds of loans people have and how low mortgage delinquencies are. But that's not all when it comes to foreclosures. If we compare the first half of 2022 to 2008, the numbers are unbelievable. In 2008, they were at 1.8% of all housing units, but right now that number is 0.12. Think about the difference there and what really needs to happen to get back to those numbers. If you are someone who believes in a market crash, we would probably have to see the number of foreclosures 10x to get to the amount of foreclosures that could flood the market with the inventory needed to see a 2008 move. But here's something that I don't think many people recognize. In 2008, the stock market tanked. We saw stocks move massively to the downside. But how much do you think home prices dropped? According to the St. Louis Fed, the median home price decreased almost 20%. So even though many people believe that it was real estate that caused much of the issues that we saw during the great financial crisis, home prices were much more stable than the stock market, and the reason for this is pretty obvious. If we look at the active listing count, which is the count of active single family and condo or townhome listings, we can see that we are nowhere near normal levels, even with the drastic increase of homes on the market. There are so many news headlines that are talking about how high inventory is. However, looking at the data, that's simply not true. Now, I don't want to spend too much more time on this, but when I look at all these different data points, I don't expect a housing crash. And this, plus their solid cash position, gives me good reason to not expect Opendoor to go bankrupt in 2023 or 2024. The next metric that I will be paying close attention to is their contribution margin. This is really telling of how the company is going to do in a lower transaction market. The higher the margin, the more profitable they will become. They have been around 4 to 6% in the last couple of years, but this past quarter, they had margins of 10%. Now, over the long term, they're expecting to get up to 7 to 9% total contribution margins. There are multiple things that have helped and will continue to help larger contribution margins, and they are reductions in resale costs from the improvements in holding costs and buyer broker commissions, lower acquisition transaction costs by improving their process for inspections, and improvements in the repair and services. I think it's obvious to expect lower margins in this upcoming earnings report, but personally, I'm expecting them to be somewhere around 4 to 6%. And the last thing that I want to pay close attention to is how their market share is doing. In this past earnings report, they said that they are now in 51 markets. Being in this many markets protects them from individual market crashes. And even though we have seen some drops in prices in several different cities, I talked to my real estate agent in Georgia, and she said that our market is one of 50 markets that has not experienced price drops. So it's clear that not every market is experiencing price drops. And that is why I want to continue to see them diversify when it comes to the cities that they're in. But honestly, I'm not worried about this Q3 earnings report because I'm looking for the long term. And because they ended the previous quarter with $2.5 billion in cash equivalents, and marketable securities, and $11.3 billion of financing available across their non-recourse asset-backed facilities, they will have the flexibility and support needed to get through this rough economy. We will see what this next report says, and as long as they continue to have relatively similar cash and financing position, I'm not worried about this one for the long term. Short term, the housing market will continue to struggle, especially as mortgage rates remain high. But as long as they survive the short-term rough patch, which I believe they will, I will be rewarded for my patience. Hope you all enjoy the rest of your week, and I'll see you in the next one.